Time to get focused with Focus on Investing.
You, good morning, good evening, good afternoon, and good night, depending on where you are. Salute to all current and future traders. Can I get a one in the chat if I can be heard? Salute to Jeremiah L. I see you in the building. How you doing, King? Let me get a one in the chat if you guys can hear me to make sure I'm not talking to myself. There we go. Salute to you got Stunning Legacy. Good to see you here. Salute to Knowledge. Good to see you. And again, Jeremiah L. I hope everybody is doing good on this fine Sunday afternoon where I'm at right now. It's 8 p.m. I think it's GMT +1 now with summertime. So 8 p.m. London time. I think we're 3 p.m. Eastern time. And I think we're midday Pacific time. I think that's my correct time. This international time zone thing, it can be confusing, you know. So salute to Mo. Good to see you here, brother. Yeah. So we're here again, back again for another Sunday session to take a look at, what's going on with the markets. Here at Focus on Investing every Sunday, we basically do what is essentially like a review of the markets for the week, right? We know that, you know, some markets are open 24/7, some markets are closed for the weekend. So it's kind of a good refresher for the week just to kind of set yourself off, exactly where you're standing in the markets, what the markets are doing, for the prospective week coming in terms of trading, what you want to do. Remember, we do stocks, we analyze Forex, which is foreign exchange or currencies, and we also analyze commodities. So again, we're here every Sunday reviewing the stock market, going through all of the different markets, going through the Forex market, and also going through commodities. If you was here last week, we spoke about why we go through all three of the markets. You know, before we get into that, when you come in the building, if you could hit the like button if you haven't done so already, you can hit the subscribe button if you haven't done so already. Also, you can support the show by hitting the Cash App. The Cash App is on the screen. British pound sign, Focus on Investing. All right. So yeah, so why do we deal with not only stocks but Forex and commodities? Well, last week we spoke about, you know, about the need to be able to traverse all three markets, right? When you think about it, we are coming into a time where we're in the fourth industrial revolution, right? The whole monetary system is changing. Society as a whole is changing. When you're talking about the economy is, being unstable at the moment. There's talks of conflicts all around the world and various different things going on. And, whether you want to say this is, just a circumstance of chance, or if you want to say this is man-made and design, whatever we want to call it, we know that the whole monetary system is going for a revolution. Good to see you, Celia. Um, yeah, we know the whole monetary system is going through a whole sort of revolution, right? We know that, we've got the advent of cryptocurrencies coming in. We also looking at, governments creating their own central bank digital currencies. We're looking at all of these different things, right? And whenever you have a situation where the economy goes, a bit pear shaped, or there's a bit of movement in the whole economy, you have to have the ability to adapt, right? Survival of the fittest is not survival of the strongest. It's survival of those who know how to adapt, right? If you're even talking about, you know, um, evolution of species, right? It's not necessarily the one that is the strongest that survives, right? It's through a process of elimination that the ones that do end up in the end are the ones that survive, right? Because they have the ability to adapt to most situations. And you find that generally in life, right? We all know those people in life that are, stuck in the past. They're still talking about the old days and the good old days, and they don't have the ability to adapt to the new ways of things or the way the new things are changing. A lot of people, oh, we don't want to get into this new kind of financial revolution. And it's going to come to a point where, if you don't adapt and you don't change, you're going to get left behind, right? So we talk about the ability to adapt because, going into this new financial revolution, the ability to understand charts and read market is going to be one of the key things that people need going into the future, right? We're in an era now where, you know, back in the day, being a millionaire was like a far off distant thing where it's like to become a millionaire is almost like a far fetched thing. Now there are so many millionaires through so many various different avenues, whether you want to call it sports, entertainment, people starting their own local businesses. When you talk about inheritance, there are so many different millionaires going around that, billionaire is a new thing. We're hearing more and more people becoming billionaires, and then the next thing we're going to be hearing is trillionaires, right? So whenever you're talking about the financial landscape, you're talking about something that constantly evolves, right? It elevates as we move forward. So, if you don't have the ability to adapt to the new times and the new financial situation, you're going to get left behind. You have to have the ability to continuously, work your money and increase your money. I've been trading for some time now. And back in the day, this was maybe about 5 years ago or so. I used to do a lot of trading for private investors, right? And what happens is if you are a good trader, what tends to happen is people who have, what they call high net worth individuals will come to you and they will ask you to trade their funds for them. So I used to be in a situation where, I was around a lot of high net worth individuals who wanted to get their finances trading. And what's interesting about, high net worth individuals is that, people think that, oh, I would love to be born into money. If you're born into money, it's an easy thing. You're born into money and you're rich. But what ended up happening was when you were speaking to a lot of these people, especially the younger ones that are coming up, you find out that it's actually quite a massive burden for them, right? They're born into families with like massive wealth, and this wealth is passed down intergenerationally, right? So you're thinking that, yeah, it's a luxury life, but what they used to express was that, it's a massive burden for them because you're thinking that, you've had this massive wealth passed down from generations from your great grandparents to your grandparents and things like that coming down all the way, and then the whole thing lands on you, right? So you don't want to be the one that messes up the bag for your family, right? Your family has gone through, life-changing wealth for centuries, and now it's on your hands or your shoulders in order to continue your legacy for your family, right? So most people would think, yeah, what we would do, we just hold on to the money into a bank. But what happens with money is, money decreases over time. If you understand inflation, you understand that, inflation isn't the cost, the price of items and goods going up. It's actually the value of money going down. So it takes more money to buy the same thing, right? So if you notice it on a small scale, you notice that, your local bread or your local milk increases in price, every so often. Imagine if you scale that up by, millions, if not billions, right? So that decrease in money increases, the more money that you have, right? So it starts to become a problem now. Imagine your family has gone through generations of wealth, and the bag falls to you, and you're sitting there and you're sitting on all of these millions in your account, and you're seeing that basically the overall value of your net worth going down. Not only is it going down, right? You're looking at competing. Now, this is big money talk. This is the talk we got to have, when we start earning our millions and we start getting up there. These are rich people problems that we're hopefully going to be inheriting soon, right? Salute to Stagmo. Yeah, so like a lot of these people, like, once you're in certain circles, you have to keep up with the wave or the movement or the level of wealth at those levels, right? Because as I said, as you go through time, the level of wealth increases. When you're looking at people like, these billionaires and things like that, when the whole world was going through, this crisis with the lockdowns and things like that, a lot of these billionaires increased their wealth. So if you weren't keeping up with them, you would fall behind the class, right? You'll fall out of that wealth bracket. So what happens is you have to have the ability to keep investing that money. If you don't invest the money then loses value, right? So a lot of these people were expressing that they had troubles trying to find ways to keep working the money, especially you know um over here we had things like Brexit and things like that, where a lot of ventures were not no less no longer viable in this country and things like that. So they were looking for various different ways in order for them to keep trading their money and keep it moving, right? So that's one thing. Once you learn the skill of being able to trade, it's something that you can do not only for yourself, but you can also, do it for high net worth individuals. You can also do it for family members. You can increase the wealth of your entire family. But learning how to, adapt to different things and to the markets is a key skill, or it's very important, right? So when we're talking about being trend traders, the trend that we're actually following is the ability to follow where the money is. Like that is really the trend that we follow. And being able to be a technical analyst allows you to look at the markets and understand on the markets exactly where the money is and where the finance is, right? So when you're talking about being able to trade, stock market, the forex market, and the commodities market, the ability to understand that where the money moves to is a key benefit of being able to do technical analysis, right? So, you know, you got to know that whenever money goes down in one place, it always goes somewhere else, right? People think that, when the market goes down, that somebody is sitting there with like a big Scrooge McDuck pit full of money, hoarding their money somewhere. No, it doesn't go that way, right? If you have a lot of money, you basically have to keep that money working. So when you see a certain type of market down, that's basically these big investors moving their money to a different type of market, right? Because if they leave that money sitting in one certain place, that means that the value of that money over time will start to decrease, right? So they have to move it around from various different markets, whether it's the stock market, then to the crypto market, then to the forex market, then to the commodities market, right? So we spoke about last week how, you know, when you see the stock market is down, oftentimes you see the commodities market up. Why is that? Because all of that money that was in the stock market was then moved to the commodities market. So now, if you don't understand how to follow trends and how to read the trends, then you don't know how to follow the market, right? And you've got to remember, you know, in order to be successful in trading, you have to be able to understand and know where a lot of these what they call big whales or big investors move their money, right? Because you as an individual, you're not going to be able to move the market. You don't have enough volume or enough money as an individual in order to move the market in a way to benefit yourself, right? So again, what we call it is trend trading, or like, I like to call it, like, you think of it like a wave in the ocean, right? For you to sail like on a surfboard against the current of the ocean is really hard, if not damn near impossible, right? But if you think about like a massive ship like the Titanic, Titanic's probably not the best example, but like a massive cruise liner, right? When that goes through the waters, you got to think about the ripples or the waves that it carries behind it, the weight that it carries behind it, right? So imagine you as an individual on a surfboard riding the wake behind one of these massive cruise liners, right? It makes it a lot easier for you to go forward and propel your momentum, right? Because you're just riding the wave, or you're riding the trend of already what's going on, right? So in order to be able to ride the wave or to ride the trend, you have to have the ability to read the markets and understand the markets in order to see, this is where the money is, right? And, again, the reason why we use technical analysis is because technical analysis over fundamental analysis is based on, verifiable and identifiable objective fact, right? So, the difference between fundamental analysis and technical analysis is fundamental analysis is basically based on hearsay, right? So when you're talking about fundamental analysis, and I have a video on the channel called, I think it's either called fundamental analysis versus technical analysis, or why you need technical analysis, something along those lines. But when you're talking about when you talk about fundamental analysis, fundamental analysis is essentially somebody saying, I think that the price is going to do this, or I think so and so company is going to do that, or I think this company, I've heard somebody say that this is going to happen with the company, right? And, whether the tip is correct or it's not correct, at the end of the day, it's hearsay, right? And how do you build a sustainable repeat income with hearsay, right? You want to be able to have a steady stream of income that comes in regular, that can replace your salary, that can, help you to leave your job and eventually give you financial freedom, right? So, and it's hard to build any kind of system or strategy around, news. And most of the time, what you find is that whenever you're getting tips or something, if you're hearing it from somebody, that person has probably heard it from somebody, and that person's also probably heard from somebody before you. So by the time that you've got the information and the news, that information has already been traded into the market through whatever channels it's taken to get to you. How many people have already got their hands on that information before you and traded that information to the markets? How many times have you been told that, oh, so and so, stock or so and so currency or so and so, coin or something is going to be trending or going crazy in the next couple of days, and by the time you've gone to look at the chart on the market to go and try and buy it, you've already seen it's already gone and spiked, right? That's because by the time the news has got to you, people have already traded that information into the markets. So you jump in thinking, I've just heard this news now, and you look on the charts and the movement has already taken place. I have a saying, you can't make money off of past price movement, right? Why do I say that? It's important because what people generally tend to do is they will look at a chart, they will see a massive spike in the chart, and they'll think, oh, look, this chart has spiked up. This chart has gone up. Yes, this is a great chart to jump into. This is a great asset to buy, right? But the issue is, again, you can't make money off of past price movement. So if the move has already taken place, that means you've missed the money. The opportunity to make the money has already gone past, right? So what ends up happening is people hear XYZ currency or XYZ stock just spiked up, 100% over the last 3 days. So I'm going to jump in now. But people psychologically think that if I jump in now, that somehow I'm going to receive the money that I've from the movement that I've seen over the past 3 days, right? And again, if the spike has already happened, you've already missed it. So all you're doing is you're getting in after the wave, or you're getting in after the trend when the whole movement has passed, right? So again, what people tend to do with fundamental analysis is they rely on news that by the time it gets to them is typically old, right? This news and this information tends to come from, people with inside sources and things like that inside the various different companies, right? So if it's already inside the company, right? See, Jeremiah is saying facts, right? We've all had that experience where we've heard about something, jumped into it, and then we've missed the move, or the move has already taken place, right? And what typically happens is this information comes from someone inside the company. But if you think about it, unless you personally know somebody inside the company, right? By the time that news has gotten to you, whoever was inside the company. So, for instance, the news is, XYZ Corp is getting a new CEO. By the time this information is known, it's known by obviously firstly the CEO, the person who's coming in, then probably the people, around them, friends or family, they might tell people, I'm starting a new job or whatever. Then people in the actual company will know who's coming into the company. So they will tell all of their friends and families and their colleagues. Then they'll pass it on to other people. And then eventually, it will get out to some kind of news outlet or to some kind of blog or some kind of site where everybody gets their news. That's where it comes from. and then somebody else will report it maybe on YouTube or something. So by the time you've got it, all of those people have had a chance to understand that information, and they've had a chance to already move the market. So say for instance, the news was that this stock is going to increase by $10. All of those people before you have had a chance to raise the stock price by $10 by the time it's got to you. So this is what's happening when you're jumping into the market after the move has already happened. You're trading on information that says the market is going to increase by $10, but the market has already increased by $10 by the time you've got that information. So you've come in, and that's where you've seen that spike. You've seen that spike after, you've seen that spike before you've actually got into the stock, right? So this is why I always say be wary about fundamental analysis. Not only being wary about fundamental analysis because the information is generally late, but fundamental analysis, again, is based on news, noise, and opinion, right? I always say, if you go out and work, hard all week, all months in your 9 to 5, earning your hard-earned money, right? You want to be able to invest that money in something that you have confidence and you can prove to yourself that that money is going into the right place, right? Again, when I was trading with these high net worth families, the whole reason that they would come to you is because you have to be able to show your work. You have to be able to show to them, okay, if you pulled up a stock from 10 years ago, why did you invest in that stock? You should be able to have a strict guideline and be able to tell them, I invested it directly into the stock because of A, B, C, D, and E, right? It's about being able to prove. I can't come to them and say, yeah, you want to invest your millions because of my auntie's friend's sister's dog said that so-and-so stock is going to go up. That's not good enough for them, and it shouldn't be good enough for you, right? You should be able to prove or justify exactly why you're investing into any particular stock. It's like, if you think about when you go for a bank loan or some funding into a bank, you can't tell them that your friend's auntie, sister's dog told you that so-and-so industry is going to be booming or so-and-so industry is going to take off, right? You have to, come, even if you watch like Dragon's Den, or they call it Shark Tank, right? When you go in there, you can't go in there saying, I think. The first thing they're going to ask you is, what are the numbers? What is the size of the industry? They're going to ask you, how many units are being sold? What's the demand for in certain territories and things like this, right? In order for you to be dealing with any kind of serious money, and again, you should be taking your money seriously like this, right? Because this money is going to grow into into a high net worth individual, right? So you have to be looking at verifiable facts as to why you're investing into certain assets, right? And this is why we look at technical analysis, right? Because technical analysis, again, is objective, verifiable facts as to why you're investing into certain different assets, right? So if you think about it like this, right? If we're looking at how we're going to identify what stocks you're going to invest into, you have to look at it from a wholesome perspective, right? If anybody tells you that they know exactly what price a particular stock is going to be, it's not true, right? Because nobody can predict the future. The stock market, as I always like to say, is the wild, wild west. Not only the stock market, any market is the wild, wild west. Why? Because we can never predict the future, right? And it is possible to predict, rough areas of price movement, but if somebody can tell you the exact price of any asset, it's just not possible, right? Because in order to be able to do that, you'd have to be able to see the future. Look at something like Netflix, for example. If somebody would have said to you, Netflix, like if last month, if they'd have said to you, Netflix, year on year, they've had growth. Netflix has been growing. They've got more and more customers, more and more subscribers every month on month. I think they was even projected to have an extra 1 point something million subscribers the following month and things like that. Hearsay or fundamental analysis will say to you, oh, Netflix is a sure bet. it's something you can't miss. Netflix is growing. It's one of the biggest companies in the world. I could give you a trailer load of reasons. Oh, it beat out Blockbuster Video. Blockbuster Video doesn't exist no more. Everybody's getting into streaming. I could give you the world of reasons on fundamental analysis, right, as to why Netflix is going to be the thing that you should invest in right now, and next month it's going to grow, right? But as we saw with Netflix, we saw that the past few weeks going, Netflix has tanked, right? The price of Netflix has gone down dramatically. We could say the same thing about Meta or Facebook. We had the similar thing. Your Statmo says the Cash App was not coming up. And what's that symbol before focus? Let me the symbol before focus is like the British pound sign. Is what it up. Let me bring it up on screen for you so you can see it. 1 second. Where are we at? Let me share my screen to some stocks. You'll be able to see it. Yeah, as I was saying, let me just bring that so you've got something to look at. You should be able to see, it's like a British pound sign. I don't know if you can see it now. It's UK currency, so if you hit the British pound sign. So yeah, so if anybody wants to support the stream, you can hit the Cash App, which is on screen. I hope that was clear. So yeah, so when you think about like Meta or Facebook, like people would have said to you, it's a sure win. They're moving into the metaverse, and you're talking about. Let me post my Cash App in the chat so you can have it. You're talking about, oh, it's a sure win. It's a bet. Yeah, my Cash App is in the chat now. Yeah, people thinking, Facebook and Meta would be a short bet. But as we see, the price of Facebook and Meta went down drastically, right? It's something you can never predict, right? So this is why we always talk about, avoiding fundamental analysis and going for technical analysis, because technical analysis is not based on hearsay. It's based on, solid, verifiable evidence, right? So even just for example, as we've got the chart up, right? It's not an opinion or a fact. So this is the US dollar index futures, and we'll go through looking at the markets shortly. But it's not an opinion. It's a verifiable fact that today's market, or the month of May, on the US dollar index futures is a bullish month, right? It means the price, if it's bullish, that means the price is higher now than when we entered into the market at the beginning of the month, right? This is a verifiable fact, right? This is not an opinion. This is not hearsay that this is that it's a bullish market, right? Or it's a bullish month for this asset, right? This is a verifiable fact, right? So it's not about guessing, right? People think that the stock market is about guessing. It's never about guessing, right? Again, I always give the example of a wild, wild west, right? So if you think about the wild, wild west, imagine you move to a whole new land. Like, let's just say, for instance, America, right? This is what we when we think about the wild, wild west of the cowboy days. And you could imagine it was wild. People were gunslinging. People were shooting each other. There was no order, or there was no kind of order to the environment. So if you envision the wild, wild west as the stock market, all right, or any sort of market really, how do you then go from that in order to then control it in a way that allows you to do any kind of investment or to have any kind of stability in it, right? Because when you're talking about investing is essentially the balance between volatility and stability, right? In order to have investment or have an investment opportunity, you need to have enough volatility in the market in order to have price movement, in order to make money from it. But at the same time, you need enough stability in order to be able to predict where price is going to move to, right? So it's a balancing act between volatility and stability, right? And it's also a balancing act between risk and reward, right? The more risk you have, the more reward you have. The less risk you have, the less reward you have. But obviously, the less risk, the more stability. So it's always a balancing act between the two. So you want to be able to have enough volatility to make money, but make it predictable, but have enough volatility in order to give you a decent amount of return, if that makes sense, right? So if you're looking about the wild, wild west, right, you think about everything is wild. How do you create some sort of order out of a wild situation? Well, you do it by creating, in our case would be laws or creating rules, right? And you got to think about, if you're in the wild, wild west, you've got all sorts of people doing all sorts of crimes and creating all sorts of acts, right? And again, it's the wild, wild west, right? Anybody can do anything. But if you're coming in and wanting to create some kind of order or some kind of law, if you're the new sheriff in town holding it down, right? You've got to think about, you know, let's create a law. So let's say, for instance, theft. You want to say, we want to eliminate theft from our environment, right? So if you want to eliminate theft, what you would do, you'd come in as the sheriff and you would say that, theft is outlawed. You are no longer allowed to thieve, right? If you thieve, you're going to go into this place called jail. And this place called jail eliminates you from society, right? So think about that now. Now you've laid down this law and you've created the enforcement around that law. Think of it like a barrier, or think of it like a filter to your society, right? Now, in theory, all the thieves from your society will now be removed from your environment and put into this jail cell or removed from society, right? So you've now created a society or an environment that doesn't have thieves, right? Well, it's similar to the stock market, right? Or any sort of market that you're trading. You want to have what we call like rules or parameters that eliminate certain factors within the market, right? So eventually, if we're talking about our wild wild west scenario, right, you're going to get to a point where, in theory, that you're going to remove or eliminate all of the people that you don't want from your environment. Salute to Jeremiah L. Just received your Cash App on the Cash Apps. Appreciate that, brother. Appreciate your support on the stream. Again, if you want to support the stream, you can hit the Cash App at the bottom of the screen. This is, if you find this information useful and helpful, and you want to invest in your financial future, then feel free to hit the Cash App. Appreciate it for that again, brother. Yeah, so if you think about it, in theory, right, the wild wild west environment then no longer has that bad actor, which is the thieves, right? You could do the same thing for, I'm trying to think of other crimes without trying to get flagged on YouTube. um let's just say treason. Let's go for that. Treason is outlawed, right? If you now put in a rule about treason, all of those people within your environment that do treason are now eliminated for your environment. So, in theory, by the end of the day, what you would have is you'd have the ideal society. You'd have the ideal role models of the model citizen, right? That's what you would have, right? You'd have the model citizen, because all of the people that you don't want or all the bad actors that you don't want will be eliminated from your environment, right? So if we apply this to the any kind of market or any kind of stock market, right, you got to think about it the same way, right? You got to have a certain parameters around your market in order to create an environment. So the trading strategy that we utilize is, we call it a HPE strategy, right? Which is based on, HPE stands for high probability environment, right? And as I said before, you can never ever predict the exact price of a stock, right? However, what you can do is you can create an environment in which, it's highly probable that a stock is going to do a certain thing, right? So let's say, for instance, your one of your elements is, or one of your rules in your environment or in your society is that, you know, a stock or an asset has to be at an all-time high, right? So let's say, for instance, that is your rule. You're the sheriff in your stock market environment, right? In your town, in your wild, wild west. If you now come in and say that if a stock is not at an all-time high, then I remove it from my environment. That means every stock that you have in your environment will now be an all-time high, right? So imagine what you would eliminate from that. You would eliminate all of the stocks that are not performing well or aren't at a certain level, right? So instantly now you've got some kind of control of over a wild market, over a wild, wild west market. You've got some sort of control, right? Because now you've eliminated a lot of the bad actors, which in your case would be stocks that don't trade at an all-time high, right? And the strategy that we use various different marks or levels in order for us to eliminate all of the bad actors from our environment. So at a certain point, you know, you get to a point where you only have the best performing citizens or the best performing stocks within your environment. I always talk about it like, I spoke about a bit about this last week about, there's a program called Air Crash Investigation. I remember the name this week. I remember the name. So Air Crash Investigation is a program that talks about, plane crashes, and usually it's like famous plane crashes and how the planes crash. So let's say, for instance, everybody's familiar with the crash of the plane on the Hudson River. I think it was in New York, and I think there was like bird strikes in the engine. It was two geese or whatever, things like that. Often, what you find is whenever you look at these, planes are very highly regulated. They have lots of different, safety regulations. They have fail safes. They have backup systems. They have all of these different things, right, on the planes, right, just to ensure safety, right? So whenever you watch one of these programs like Air Crash Investigations, again, you will never find it's one issue that causes the plane to come down, right? And follow the metaphor here. Yeah, you're correct, stock more. It does. um, yeah. So when you're looking at a plane with various different fail safes, right? You're talking about, you know, um, when a plane goes down, it's generally multiple things that happen, um, not just one thing that happens. So I was watching one incident where, you know, it's the fact that there was some kind of, the plane was supposed to have like safety checks. The safety check didn't go through because somebody was sick. Then the plane was on a certain amount of miles that was supposed to go and check on it. They didn't come through and do their check. I saw one where there was actually, I think there were Japanese pilots, and actually one of the co-pilot, who was younger than the main pilot, actually saw that there was an issue with the plane, right? But the reason why they didn't notify the main pilot, who was, I think it was either intoxicated or something like that, was because of, in Japanese culture, you can't, um like, it's disrespectful to kind of correct or address somebody who's an elder. So all of these things ended up happening in order for the plane to crash, right? So when you look at all of these things, it's a number of things that have to happen in order for the plane to crash or for it to go down, right? So we look at it the same way in the stock market. You want to create so many different rules and so many fail safes that that your stock can't fail. It has to fail so many different levels of safety checks or so many different levels of parameters in order for your stock to fail, right? So this is what we call a high probability environment. It's part of so many different levels of parameters or high bars or high marks that it's a high probability that the stock will succeed, right? So this is what we do. We create what we call a high probability environment. Now, there are other things that we add on top of that to even mitigate even the ones that do go through and might not succeed. You've got even other ways to mitigate losses and things like that. So there's layers on top of layers on top of layers to ensure that your stock is going to succeed, right? So in trading, we call what we have what we call an edge, right? And your edge is another word for your strategy, right? Your edge is basically something that gives you an edge on the market, right? So you're looking at when you're looking at markets, a market is basically a place where you bring people together in order to buy and sell and trade. So essentially, you're you're competing against other people in the market. If you think about it like trading, I mean not like trading, like betting. If you go to like you're betting on a fight, say for instance you're going to bet on Canelo versus Bivol, right? Whoever's betting on those, there are some people that are betting for Canelo to win, some people that are betting for Bivol to win, right? And essentially what the market maker does or the bookmaker does is that they put together the people that are for something and the people that are against something, and they basically offset the money or the finance between the different people who bet, right? So essentially when you're looking at going into the stock market, you are basically hedging your bets against those people that think that the price is going to go up are putting their money against people that think the market's going to go down, and those that think the market is going to go down are putting their money against people that think the market is going to go up, right? So you're essentially competing in the market as we do, right? So when you're talking about an edge, you're talking about how do you get an edge on your competition in the market. So this is why they call strategy in trading, they call it an edge, right? So how do you get an edge on your competition in the market? So your edge is basically your strategy. It's your identity in the market that allows you to trade, right? So again, this goes back to why we use technical analysis over fundamental analysis. Your edge or your trading strategy should be a set of rules that allow you to separate and identify clearly whether or not it's a good investment to invest in or it's not a good investment to invest in, right? It should be clear, a clear yes or no. There should be no emotion in trading. All right. We always speak about, controlling your emotions and not being emotional in trading. Well, how do you do that? You do that by having a clearly set of defined rules in your trading strategy, right? So let's go back to our previous example of all-time highs, right? Let's say, for instance, your first rule in your trading strategy is that a stock must be at all-time highs. It's a very clear analogy, right? Or a very clear example. There is no gray area as to whether a stock is at all-time highs or not. Each stock has the exact price that it's at. Let me go and pull up. Let me see. I don't even know if this one is as an all-time high. It's not really. But let's go back to. Let me go back to here. Just to use this example. So this is not even a great example. All right, let me do this. Let me go to the UKX. Yeah. So let's see where we're at. So let's say, for instance, our all-time high was here. So okay. So this market at this point was trading at all-time highs, right? It's very clear and very obvious and very identifiable that this is at all-time highs, right? Why? Because you can see the current price that it's at. So at this time, it was trading at 7678, right? You can clearly identify that that is trading at an all-time high. You can go along all the price in its previous history and see that it was never trading at that price level previously, right? So you're looking at an objectifiable, identifiable fact, right? So if one of my rules in my trading strategy is that I only trade all-time highs, right? Then nothing that is not at an all-time high can pass through that filter, right? And it's very clear, either yes, it's an all-time high or it's not an all-time high. It's not I'm trading in it because my auntie's friend's sister's dog said that this is a good stock to invest in. It's not because Focus said it. It's not because you like me and you like my channel and you like my streams, and because you like me and I said to go there, that you're investing in it. No, this is nothing to do with me. This is nothing to do with emotion. It's not to do with who you like. It's not to do with how you feel. It's not to do with because you woke up this morning and you felt good. It's not because you woke up this morning on the wrong side of the bed. It's not because of any of those things, right? It's because of you have a rigid, very clear and identified and defined trading strategy that tells you yes or no if you're investing into something. Salute to Stackmo again for another investment in the channel. So I appreciate your investment in the channel, so we can keep this knowledge coming and flowing. Again, if you guys find this stream and information helpful, then feel free to invest in the stream by hitting that cash app. Thank you. Salute to Knowledge. Good to see you. Yeah, he said don't forget to hit the like button. Yeah, so it's not to do with your emotion or how you feel on the day, right? Whether or not you chose to invest in a particular stock. You can have it written on the wall exactly, either yes, this thing is at an all-time high, or no, it's not, right? So this is how you eliminate emotion from your trading. And then what you will do is you will build up a set of different rules that allow you to filter out these stocks and these investments. So we use a lot of indicators. What are technical analysis indicators? Well, all indicators are simply mathematical calculations on price, right? So when you're dealing with technical analysis and when you're dealing with the charts, you're dealing with essentially it's just math, right? All they're doing is reporting to you the price of a certain asset, right? So if you know the certain price of it, then you can form mathematical calculations based on the price, right? So if we go back to our trusty friend, the moving averages, these lines on the charts are representing the average of price over a certain amount of time, right? This average of price is a calculatable fact, right? You could sit there with your ruler and your pencil and you could calculate the average price. You could calculate the price of each one of these bars. You could then divide the price in order to get the average, and then you could plot the line on the chart. It's like it's something that you could identify. You can identify and verify by fact, right? So if you think about that, right, you're talking about something that is factual about the price of a stock, right? It's not an opinion of the stock, it's factual about the price of a stock, right? So either the stock is above this line. Let me get my my pen out. So so let's take, for instance, this black line. This black line is our 200 simple moving average. Either price is above the line or price is below the line. It's one or the other. It's well, it could be alongside the line as well, technically. But it either is or it isn't. Is it above the line? Yes. Is it below the line currently? No. Right? This is the objectable, identifiable fact, right? And each one of these indicators that we utilize represents a certain thing on our price, right? It's a certain thing that we create a high bar or a level of excellence in order for this to pass through. It's like, going to any, prestigious school or college or anything like that. If they give you an entrance exam, you have to pass the bar in order to be entered into this environment, right? Well, we're doing the same thing. We're using certain specific indicators in order to set a bar or a filter or create laws in our wild west environment to filter out, all of the bad actors. So what you want to do is you want to have a set or a list of, rules. And again, these rules or these laws are things that you don't break. Why? Because, you want to have a consistent set of rules or laws, simply because, you want to be able to evaluate your strategy, right? If you keep changing your laws, or if it's based on your emotion or how you feel on a certain day, right, you're going to find that, there is no consistency in terms of your strategy. You're not going to be able to know whether your strategy works or if your strategy doesn't work, simply because of the fact that you keep moving the goalposts. There is no consistent strategy that you have to say, yes, my strategy works, or no, it doesn't work. I need to, evolve it. And this is, again, another reason why we like technical analysis over fundamental analysis, because if somebody tells you XYZ stock is going to do well next week, how do you then take that information and apply it going forward, right? If you're looking at building, generational wealth, if you're looking at building a steady income stream, over a long amount of time, how do you do that with information that XYZ stock is going to do well next week? Okay, let's say, for instance, it's true. You put money on XYZ stock next week and it makes money. How do you then continue that with another stock, or in future history and going forward in time? You can't do it, because it's not a repeatable process, right? If you want something that's going to be consistent with a consistent income, you need to have a repeatable process. So this is why we like technical analysis, because technical analysis gives you the same set of rules that you can apply over and over and over again to your stocks, whether it's today, whether it's tomorrow, whether it's next week, whether it's next year, whether it's 10 years from now. This is why I said you can look back at a stock in 10 years and still tell yourself exactly why you invested in it. If somebody was wanted to give you money to invest and asked you why you invested into a certain stock or why that stock was successful, you can show them exactly what your trading strategy is, point by point, and why that was successful, right? You can have that. It's something that you can apply. You can also apply it to different stocks, right? Whether or not, a stock is successful based on a tip that somebody told you, it can't be applied to a different stock. Whereas if you have a certain set of rules and guidelines as to why you would invest or you wouldn't invest into a stock, that can be applied from stock to stock to stock to stock, right? So not only could it be applied to the same stock over different times, it can be applied to different stocks, right? So this is how you build a wholesome edge or a wholesome trading strategy, right? Because it's the same rules that apply over and over again. Now, the thing is, the hard part about that is about discipline, right? You have to be disciplined enough to stick to your trading strategy. And this is the hard part about trading. And this is why, I say trading is almost like a spiritual practice. I know it sounds crazy. You think that, oh, you're just looking at numbers on a screen, but it's really almost like an internal thing. Why? Because it's about having faith in yourself, right? You have to have faith in yourself and trust in your trading strategy that, if you if you have faith in what you've put together in terms of a trading strategy, or you have faith in terms of the trading strategy that you're following, that you want to stick to that no matter what else is going on in the wild west. Whatever's going on in the market, you have to have the ability and the faith to stick with that. I remember when I was trading, I think it was when Trump came into office, right? When Trump came into office, the markets, the US markets tanked, went straight down in basically a straight line, right? And at the time I was trading, and I knew the markets was going to go straight down in a straight line. But because of the way I trade, and because I have faith in Jeremiah L says the mental fortitude, right? Again, having, faith in yourself, right? So I knew the markets was going to go straight down. And it would have been so easy for me just to hit that sell button and ride the price all the way down. But why didn't I do that? I didn't do that simply because, you know, I knew that I had to stick to my trading strategy, right? I knew that my trading strategy was my force. You know, if you're talking about using the force, my trading strategy was the thing that was going to protect me in the markets, right? So there's no telling that I could have jumped in the market and the whole thing could have reversed on me and I could have lost a load of money, right? So, you know, what I had to have the discipline to do is watch this market or the chart move solely in one direction, and I had to have the discipline to sit out of it and say that I have faith in my strategy and also confidence, and also not be emotional. I wasn't emotional to think that let me emotionally jump into a market and run into that. I had to have the discipline to say to myself, no, this is not, you know, part of my trading strategy. It does not apply to my rules. And therefore, I'm going to sit out. Even though I can see this chart moving solely in one direction, I'm going to sit out of it because it doesn't comply to my trading strategy and to my rules. And I have, excuse me, I have faith that, you know, there are going to be more opportunities coming in the future. Again, our abundance mindset. You have to have that abundance mindset. You think about how many stocks there are out in the market. It's thousands, if not tens upon thousands of various different assets in the market. You know, one, it's not going to be one stock or one asset that's going to make you rich or going to make you wealthy, right? It's consistency over time. And that consistency over time comes with a solid trading strategy that you can apply day in, day out, that is going to give you, you know, steady returns. And again, this is how you build, you know, a reliable income, something that you can, you know, quit your job, that you can, you know, build financial freedom from, because it's a regular thing that you can rely on, right? So this is how you go about picking, you know, great assets to invest in. Have a strict, rigid edge or trading strategy with clear, identifiable rules and points, you know, that can give you a clear answer, yes or no, whether or not you should invest in. And let's say, for instance, you have a 10-point strategy. Only if your asset meets all of those 10 points should you then, you know, go ahead and invest in the stock. And you should have the confidence and faith that even if you hit 9 and that 10th one doesn't make it, you have the confidence and faith and the abundance mindset to say that, you know what, I'm not going to invest in this because there's going to be a better one that's going to come along, right? At the end of the day, trading is as much about what you don't invest in as to what you do invest in, right? If you go around investing in everything, you can throw away all your profits back to the market. You might have one great asset or one great stock that made you a lot of money, but because you made a lot of decisions with all the bad ones, you ended up giving away all of your profit, right? Another thing that when I first started, we have certain rules around your risk management, how much you should invest into various assets and various, you know, stocks and things like that. This is also important, right? Because maintaining a good risk strategy is what you need in order to build profits, right? What can often happen is we become undisciplined, and again we get emotional because we say, no, this stock is the one, this is the one that's going to go big, this is the one that's gonna do big time, this is the one that's going to make me rich, this one's going to make me a millionaire. And then what we end up doing is, because of emotion, we over invest in a particular stock, rather than, you know, equally treating them the same, right? We don't have any emotions when it comes to trading. And again, this is why we go to technical analysis, and this is why we go to our checklist, or our high probability environment checklist, right? Because, you know, it's easy to get swayed by big names, right? Most of the time what you'll find is the best performing stocks are stocks that you've never heard of. I would say a name to you and you would never even heard of it. I'd say maybe with the exception of Microsoft has performed well in the past. Let me pull up Microsoft. SFT. Microsoft in the past has performed pretty well. Let me go to the monthly time frame. If you look at that, an overall chart has performed pretty well all the way up until 2021. It was very, bullish, very good looking chart up until that point, right? But this is kind of a rarity that you would find in name brands. And what typically happens with fundamental analysis, people get, people get enamored with the name of it or with the emotion of it. They think about, oh, somebody said, salute to Order of Caligula. How you doing, brothers? Good to see you. Yeah, people get engrossed in the romance of it. They think, oh, somebody tells them, Nike or Nike, depending on where you live and how you pronounce it, it's gonna do well next week. And you think, oh man, I remember when I got my first Air Forces, they were crispy white, and I went to this party and I met so and so there, and I had such a good time, and my fit was together. The drip was looking crazy, and right, you start doing all of these emotional things around it because of it's a name brand that you have some kind of emotion with. And we as human beings are emotional beings, right? So what tends to happen is we put the emotion that we attach to a brand in with our trading, and we subconsciously think that a certain stock or certain asset is going to do better than it actually is, simply because we have an emotional attachment to the brand name, right? So this is something that having your clearly defined rules allows you to eliminate, right? Because when you have your clearly defined rule, if it doesn't meet your clearly defined rule, no matter how well um you know you like having an iPhone, so you want Apple stock to do really well, or I just got the new MacBook, so I want to be able to invest in it. No matter how much emotional attachment you have to a particular brand name, it won't matter. It won't skew your investment. You won't get emotional when you're getting invested into the markets, simply because it doesn't meet a checklist. It's not a hard and fast simple rule as to whether you should invest or not, right? So again, we like to use technical analysis with clearly defined rules in order to know whether or not you should invest or not into a stock. And we also utilize the aid of technical analysis indicators, because these are clearly defined, mathematical calculations based on price that we can see on our charts that give us an objective, point in order to say whether or not we invest in something or not. We have a comment from Celia. It says, I am learning to remove my emotions. I think my emotions rule because I am not yet 100% confident in my analysis. I trade Forex. Again, this goes back to probably because you don't have a rigid set of rules and defined rules whether or not you should invest into a stock or not. Now, don't get me wrong, there's an element of trading that is art over science. At a certain point, if you're lucky, you would have a at a certain point, you if you're lucky, you have your set of rules, and you'll go through these markets, and you have what you call a watch list. Our watch list will be all of those assets that made it through your checklist. Now you can, I don't want to say get emotional, but there's an element of emotion after that, right? Because now you have a bar. Like let's go for our example of like a college or university. Once you start your first day of college or university, everybody in that college or in that class has taken that entrance exam and has made it, right? So everybody in there is at a level or a certain standard, right? They've already been pre-qualified to even be in the room, to even be in your environment, right? It's a certain level. It's a higher level environment, right? So when you get to that point, now you can start being, I don't want to say emotional, but for lack of a better word, you want to be emotional, or you could be a bit more objective or discerning about, okay, all of these, let's say for instance, for example, of all-time highs, right? We've got 10 different assets here that are at all-time highs. Now we can start looking at, okay, although they're all-time highs, we can again tighten our rules even further. Out of those that are all-time highs, which one has the best, trend or best performance at the all-time highs, right? So now you already have your environment where all of these assets are great assets. Now you're just picking the best of the best, right? You're looking at, okay, they're all good. So now we want to put, it's not just that we're at a prestigious university now. We're now picking the model student in that prestigious university. We're picking the prefect. We're talking about the one that's going to be, the one that's on the class captain and all of these things like this. We're picking the best of the best. We want the cream of the crop. We want to put as much, you want to put as much goodwill behind ourselves to try and ensure that this asset or this stock is going to succeed, right? So it's only at that point that you can start getting a bit emotional. I don't like to use the word emotional, but in this case, it's not even really emotion, right? You're using your discernment in order to identify between the best of the best, which one you want to pick out, right? And then this is how you end up with the cream of the crop stocks, right? Or the cream of the crop assets that you want to invest in, because you've gone through your rigid strict checklist, which is your science, and then you're now utilizing your art to see which one is the best, which is now the so you're then using your eye to see which one is the best, which is the art. So you're using art and science in order to get the best stocks in order to invest in, right? So again, this is how you pick the best stocks to invest in right now. All right. We've got a comment here from Order of Caligula. He said, I'm still trying to figure out how to read these charts. Are you part of focusoninvesting.io, our Patreon? I don't know if you're a part of that. If you are, we've got a whole full investment syllabus on there, which basically takes you through step by step from everything from how to operate this platform. This platform is called TradingView. We've got a whole from the beginning of how to set it up, how to operate it, all the way down to how to maximize your money, how to balance your risk and things like that. Okay, if you could look on the screen, you can see it says, if you go to focusoninvesting.io, you can go in there, you get our full our full trading strategy. Not only that, we give you the key indicators, the key technical analysis indicators that you should be utilizing in order to differentiate your stocks, right? In order to no problem, Order of Caligula. I'm happy that you're here with us, riding through the journey, and this is what we're here for. For people, either even if you're starting to get into trading, or if you've been trading for a while, and you're finding that you're struggling, or to try and get any kind of success. There's a lot of misinformation, and a lot of confusion, and a lot of sales, to be honest, in trading, and people not giving you, clear instructions on how to trade and whether you should invest or not. Our trading strategy is very clear. You either do or you don't invest. Again, we give you the key indicators, telling you, as a clear objective, line on the chart or something like that, whether you should, if it's above the line, invest. If it's below the line, don't invest. Very clear indicators. So we also give you, access to the indicators. A lot of the indicators that we use were custom coded by myself. So these are like proprietary indicators that we custom coded, giving you certain information. Let me show you one of the indicators that we use that I find is a really good one that I'm quite proud of myself. It's the one that I call the BOI, or the BOI, or the breakout indicator. And this one basically plots a little symbol. If you see here, there's a little green dot below this green bar. On this red bar, there's a red dot above it. This is basically, when you're dealing with technical analysis and you're talking about indicators, it's basically creating a mathematical calculation on price. And if the mathematical calculation outputs a certain value on price, then it can plot a certain indicator on the screen, right? So the reason why we call this the buoy or the breakout indicator, it basically indicates whether or not a stock is about to break out, right? And not only whether or not it's about to break out, if it's a good bar in order for you to invest in. So we use this as one of our checklist points for our high probability environment, right? So this is a very clear indicator of what bar you should invest in, right? Because it's clearly defined. It's giving you a clear, if you want to call this a dot or an arrow, or if you want to call it, onto the exact bar that you should invest in, right? And again, along with our other indicators and other parameters and metrics that we utilize to define stocks, it lets us know that this is a particular bar that we should invest in. So that is just one of the indicators that we utilize. Not only that, we do what we call stock lists or trending asset lists. So we even go through the length of creating a certain amount of parameters and give you a reduced checklist for you guys to just basically go through. So imagine how many stocks there are. There are tens of thousands of stocks all throughout various different markets, right? What we do, we condense that list down and pick, all of the best stocks that are actually trending for you guys to then, reduce the amount of stocks that you actually go through in order to have to, evaluate from, right? So, it reduces the workload of having to go through and knowing where exactly to start with all of these stocks, right? If we give you a weekly stock list, you can then go through those already pre-selected. We've already given a certain amount of parameters on there. They're already pre-selected for you to then discern which ones you want to invest into individually, right? And then on top of that, we also have what we call the premium stocks. So basically, I tell you, this is the one to invest in, and this is the price to invest in at. There's no analysis needed. I can just tell you exactly this stock here at this price, buy. And so we take all the hard work out of it for you. So if you want to earn money while you're learning how to invest in the stocks, then that is something you can do with our premium trades, or I call it like copying my trades. The trades that I would take, its ability to just copy what we're doing until you get on your feet of being able to learn and understand to read the charts. You can make money from the beginning. So don't worry, Order of Caligula. You can learn how to read charts. And what happens is as well, if we keep feeding you what the good charts are, or what the charts that you should be investing in are, you would be able to start to understand what a good one is, right? So you start to understand and train your eye and say, oh, this is what a good chart looks like. This is what something that you need to invest in. This is, you start to train your eye, right? You be able to see to the point where now I could just look directly at a chart. I don't even need the indicators for myself. I can look directly at the chart and tell you whether or not it's something good to invest in or not, like without even having to go through the checklist. Now, obviously I do before I invest in, because I don't want to be emotional, but you get to a point where you can just by eye see whether or not something is a good investment or not, because you've seen enough good investments that you can now see one soon as you see it. And again, like, this is why we like trading, right? Because you will never get rich, or you never get wealthy exchanging time for money, right? If you go to a 9 to 5 or something, you get paid by the hour, right? There's only a certain amount of money you can earn in a day. So the maximum hours in a day you can have is 24. So it's whatever you're earning times 24, right? Whereas if you're talking about investing, you're talking about leveraging, right? When you're talking about leveraging money, you're talking about leveraging not only your money, but you leverage your time, right? You can disassociate the amount you earn income wise from time, right? So it's about leveraging that money without it being related to time. So if it's not related to time, it's not costing you time, right? Therefore, time is your most valuable resource. So you're disconnecting your money from your time, and because you're disconnected it from your time, you've now freed up your time. You now have free time while still earning that money, right? So because you've disconnected it from the time, it allows you to have more freedom. And this is why, here all we're doing is taking 20 minutes a day in order to earn, money that are people's yearly salaries in maybe a month or in a week or things like that, right? So you're looking at being able to leverage your time 20 minutes a day in order to make have financial freedom, right? And this comes from the reason why it's 20 minutes a day is because you get to the point where you can train your eye. So if I give you a stock list, you can flick through that list. You can look in seconds, you can go through the list and know whether or not you should be investing in something, right? So we're not spending lots of time on these things because we are trained ourselves to be able to see great investment and just be able to go through the list and flick through them quickly, and to know whether or not we should invest or not. Now, if it's something you do want to invest in, then again, as I said, you've got your checklist, you can take your time, you can go through, you can set up your trade and your parameters and things along those lines in order to invest in. But again, you don't want to be wasting your time on stocks or assets that are not worth investing in, right? So something you can just simply flick through once you've trained your eye. All right. But again, this will come, this is what comes through, being able to train yourself and being able to, again, it's a skill set. And this goes back to what we spoke to at the beginning of the session, right? We're talking about moving into a whole new different industrial revolution. We're talking into a whole new, different era when it comes to finances and the markets. And what that's going to allow you to do, having a skill set, you're going to be able to look at the stock market and say, okay, the money is not here. Let me go and look at commodities. We saw the other day that palladium was at crazy prices, right? If you'd have had the eye, you can look into it and say, okay, this is something that's going up now. This is where all the money is gone. The money has moved out of the stock market. Now the money is in palladium. We saw prices raising so crazy that the government had to stop trading on certain assets and certain commodities, right? Because the money was going crazy over there. So imagine you had the ability to be able to perceive where the money was going before they got a chance to stop it, and how much money you would have raised riding those markets going up, right? So your ability to train your eye and have that skill to be able to read markets, and reading markets again is about following the trend, and the trend is the trend of money, right? You need the money, you need to be able to see where the money is going so that you can basically go in and claim your share of that money that's moving, right? So again, this is what we're doing. We're training our eyes to identify good assets and skill sets. And what's funny is now that I'm trained with this skill, it's kind of funny because somebody can tell me, oh, XYZ is a great stock thing to get into. Like, again, going back to the old, my auntie, sisters, your auntie sister would be related, but your sister's friends, cousins, dog said that XYZ stock is great. As soon as I pull it up on the chart, I could tell you the moment I see it, whether it's a good investment or it's a bad investment, right? So Order of Caligula says, where can I train my eye to get to that point? Simple. How you get your eye to that point is by getting used to seeing what good assets are to invest in, to see what good trades are to invest in, right? In order to do that, you have to, again, you have to have, there's two different ways to do this, right? There's a slower way and a quicker way, right? So the slower way is basically, all right, let's go. Okay, there's three ways. Let's go with the slow, medium, or fast way, right? So the slowest way would be trial and error, right? You could go into the markets kind of on a free for all, and you could try this strategy. If it doesn't work, you try something else. You try something else, it doesn't work. You keep trying until eventually maybe you catch a lick and you start seeing successful trades and then that's how you start seeing successful trades, and your eye starts to trade. Your eye starts to train because you've seen enough certain amount of successful trades. That's the slow way. The medium way to do it is, if you go to Focus on Investing, we give you the complete trading strategy, right? So, as you go through the investment syllabus, it will teach you each step in order to identify, what is a good trade, right? And you'll get to the point where once you understand the strategy, you understand how to read the markets. And then once you understand how to read the markets, you'll be able to see which stock is a good stock to invest in and which stock was not a good stock to invest in. So that's the medium way. The quick way to do it is to basically see the trades that I'm doing, and you'll basically be able to, like, it's funny, right? Once you start seeing what good trades are, it's so clear, it's so obvious to you. You can just off the top of your head be like, oh, that's what a good trade is. Because most of the difficulty in trading is, you don't know. There's they say there's four things. You know what you know, you know what you don't know what you don't know, and you don't know what you don't know, right? So the worst thing is that what you don't know that you don't know, because you have no idea of what a good stock even looks like. So you don't even know if you're looking at something that's good, but you're not investing it because you don't know that you're seeing something good. Conversely, you could be thinking a trade is a good trade, or this is a good asset or a good stock, and it's actually not. But because you haven't seen what good ones are, you don't know how to interpret that or how to process that. It's a similar of in life, right? People adapt or accommodate to whatever they're used to in life, right? So if you're used to, eating McDonald's burgers, all your life, and somebody introduces you to, filet mignon or wagyu beef. I don't know if you guys know about the wagyu beef. I think that's the Japanese one. Is it? I think it's Japanese wagyu beef, where they massage the cow and all of those things, tender and all those type of things, right? If you're not used to the wagyu beef, right, and you're used to McDonald's the whole time, you will taste the wagyu beef and you'll be thinking, wow, this isn't McDonald's. I don't like, what is this? This isn't the quality that I'm used to. Whereas it's a higher quality than what you're used to, but because it's different, you're not used to different, and you set your expectation or your comprehension is based on a lesser level, right? So this is about elevating your consciousness around what is a good investment, in order to have the eye and be in that environment around what is a good stock and what is not. Like if we go back to our university example, the environment is already excellence, so we're picking excellence from excellence. Your expectation is different because what the environment you're used to excellence, so you're picking at a higher level. Whereas if you're used to not having excellence, you're going to pick from, something that is not excellent, right? So what we like to do is, like, if I'm giving you like just the investments that I'm investing in, you're able to see, okay, this is what's hitting. These are what successful investments look like. This is the shape that you look at, right? Um, and that is something that allows you to train your eye. Your eye becomes familiar with, this thing is looking good. I'm used to seeing excuse me, I'm used to seeing enough good investments that I can identify which is a good one and which is a bad one. All right. So, this is how you train your eye um, to get to that point. Again, it's just really experience. And obviously, these things take time. As you are more and more in trading environments like Focus on Investing, as you're around, other traders in our environment, in the community, you're going to be able to, you know, you're going to be able to learn from each other, and get into that environment of knowing, okay, somebody brings up this issue, and then you start learning a little extra thing about a stock. Okay, this is an extra thing I got to watch out for, or this is an extra thing, and this is an extra thing. And like, over time, your experience and learning about the different nuances about different stocks starts to build. I always say that each stock has a nature, right? A nature of a stock when I say a nature is that, each stock is based on a company, and um, each company has a certain company ethic or a certain way that the company carries out business, and that is reflected in the price of the stock, right? So each stock has a certain nature. So you can start to identify the nature of the company by looking at the stock, right? And depending on the nature of the chart pattern of the stock, it tells you a lot about the company. And if it tells you a lot about the company, right, you can start identifying certain nuances in the price movement that might tell you, okay, this is not something I should invest in because I've got to watch out for, this little thing here, or I've got to watch out for that little thing here, or this is something good to look at, or, all of these things come from experience because, you start to get into the flow of the stock. And this is why I say almost, it's it's almost like a spiritual practice, right? Because you can almost start to feel the stock. It sounds a bit crazy, but you can feel it by looking at the nature of it and how it's moving and how it's flowing and how it's plotting. And once you start looking at that, you can then start to understand its nature. And then it's the same thing with people. If you don't understand someone's nature, you can kind of predict what they're likely to do in the future. If somebody's a wild and crazy person, they're likely to do something wild and crazy in the future. Whereas if somebody gives you a trustworthy, when you meet somebody from RIP, you can kind of get that connection with that person. You can say, oh, this person seems cool. I can resonate with this person. I can instill some certain amount of trust in this person. Conversely, you can say that this person is crazy. I want to get away from this person as soon as possible. I don't want to be a second longer around this person because I'm going to end up with problems around this person. Well, it's the same thing as Jeremiah says, intuition. You have that with stocks, right? You can be able to see the nature of the stock and then predict almost what it's going to do in the future. Okay, this is going to go well in the future because I can read the nature of it. Or this is going to be a terrible investment in the future because I can see and understand the nature of this. I've seen so many patterns like this before. I know where this is going. This is going to end badly or this is going to end well, right? You can understand these things. And again, these things come from, building your intuition, as Jeremiah L says, and building up your eye of seeing good stocks over a certain amount of time to be able to then, identify and differentiate good from bad. Same in life, right? You've seen enough good people, you've seen enough bad people to know whether this person is going to be good for you or this person is going to be bad for you. And again, it just comes from experience. It's just part of human nature. All right. So yeah. So Jeremiah L says, have you covered any chart patterns yet? No, I haven't. I want to leave this last half an hour open for anybody got any kind of questions, any kind of comments, any stocks you want me to look at, anything you want me to go through in particular. I don't know if Jeremiah, if you had a particular chart pattern you wanted me to go through or something along those lines, or if anybody has any questions in particular you want me to cover or go through. Again, if you haven't done so, please hit the like button. If you haven't done so already, you can hit the subscribe button. If you would like to, invest into keep seeing these streams and keep seeing Focus on Investing grow, you can hit the Cash App. The Cash App is at the bottom of the screen. That's the British pound sign with Focus on Investing. Let me give you guys a few more seconds to see if you guys have any particular questions or any chart patterns you want me to particularly look at. If not, I will go through the markets overall. Let me give you guys, anybody with any questions? If not, I'll go through the chart patterns the markets to kind of give a overall of what we've been going through. All right, I don't see anything coming through, so let me just keep checking back. Okay, Jeremiah, we've got some. Jeremiah L says a cup and handle and chart patterns. So when you're talking about chart patterns, okay, I see you order, Caligula. Let's go through AMC chart pattern, the controversy. Okay, so to go back to cup and handle chart patterns, when you talk about chart patterns, chart patterns are essentially just us giving a name to identify things that we're seeing, right? It's the same thing to do with just general life, right? We name things in life in order to identify and understand what they are, right? So if I say to you a bird, if I say a bird, everybody's now picturing a bird, right? Everybody is a clearly identifiable thing. We can say that this is a bird because I've said it, and we all have a common understanding of what a bird is, right? If we look at chart patterns are essentially just ways for us to name what we're seeing on screen, right? So let's say, for instance, because we've got this chart up, Microsoft, we're going to use as an example a double bottom, right? So for those that don't know, a double bottom is essentially like a W shape, right? So let's say, for instance, we're going to take this area here. We're going to look here at this area here, right? So in this area, we have what we call a double bottom. So when we're talking about double bottoms, it's essentially, let's say, for instance, we can see that price has come down, come back up, come back down, come back up. So it's come down to this level around here. So if we draw a line here, right, trying to say that this line is the bottom of price. It's again, pricing is never an exact price. As I said, it's always a rough area, right? So if we say that this red line would be our bottom, then this chart pattern here has come down once, hit the bottom, pull back up, pull back down again, hit the bottom twice. So that was a single bottom. This here was a double bottom, and then pulled back up again, right? So this W looking shape here was what we call a double bottom. It's price hitting our bottom level, or what we would call a level of support once, pulling back, or what they call a retracement, pulling back, coming again for a second time, hitting the bottom again, which is the doubling of the bottom, and then pulling back again, retracing, right? So we call this chart pattern a double bottom. Now, we call it a double bottom just so that we can identify the pattern. When we say double bottom, it's an identification. Now, just calling it a double bottom doesn't really mean anything, right? Whether you knew it was called a double bottom or not is not really relevant, right? What is more important goes back to what we spoke of previously. And what we spoke of previously was more understanding what the chart is saying and what the chart is telling you, right? It's about understanding what this chart pattern means, right? So when we're talking about a double bottom, we're talking about price that wants to go lower. At this point, it wants to go. So let's do it this way. We're looking at, if we start from here, right? We had, price was on its way up. We had, strong green bullish day. And then we had, two green candles, then we had a red candle and a green candle. But, overall price is going up, right? So we're seeing price, the market is telling you that the price wants to go up, right? So we move forward, we get a red bar and red candle. So prices, the level hasn't actually dropped, but we've had a bearish day. So a day that's gone down. If we move forward, okay, we see prices going down. So we're seeing that the market wants to go down. We've come down again, so the market is on its way down. We've got to here, and now this is a different type of bar. And again, there's chart patterns and there's candlestick patterns as well. You can read different things. But nevertheless, we can see that price has gone down. So we can see that price wants to go bearish. It wants to go down. When we see it do that, it's basically bounced off of our support level. So this support level is telling you, when it bounces like this, it's telling you, the market is telling you that for some reason the market doesn't believe that the price of this stock or this company should go below a certain price. It's worth more than that, right? So the market doesn't want to go below that. And besides that, when it's hit this low level of, in our example, 276, when it's hit that price, the market believes that actually for the current value of this stock, it is actually too cheap, right? This stock is too cheap. So the market has then bought out and the price has then come back up again. But then what happened was the market still has an intent to go lower. So the market has, on the second attempt, come back down again, right? So it's on the first time of asking, it's asked the question, should this stock be at this price, right? Should it go lower than this price? It's made an attempt to go lower, and the market has said, no, it's kind of pulled back, it's retraced. So then it's gone for a second time of asking to look to see if it's going to go lower. On a second time of asking, once again, its price has bounced off of this level, right? So you got to look at it this way. I always look at like support levels like a door. Like imagine a door is either not even locked, it's like a stiff door you can't go through, right? If you try to push on the door, and you don't go through, what you might do is you might take a step back, take a bit of a run up and try and push the door to see if it will open again, right? The second of time of asking if you try to go through this door, you realize that with the amount of force or with the amount of energy or with the amount of intent that you have at that time, you don't have the intent or the energy or the force to go through this door. Therefore, you're going to back off the door. And it's a similar thing, right? The market is asking the question, should the market go lower? But there's not enough energy or an intent in this stock or enough, bad sentiment around this stock in order for it to go lower. And therefore, it can't go any lower and it's therefore going up. So this is a good sign if you was planning on the stock to go higher or planning on the stock to go up, or if you was planning to buy the stock, or you was counting on the stock to go if you was planning for it to go bullish, this is a good sign because it's attempted to go lower twice and it hasn't been able to. The market has tried twice to go here and it hasn't been able to break this 276 area. So this is an indication that the market does not want to go lower. And then by, almost default, it's an indication that the market has more intent to go higher than it has to go lower. All that being said is what the double bottom means. So when I say double bottom or anybody says double bottom, that is essentially what they're indicating, right? Now, whether or not you knew it was a double bottom or not is irrelevant, because if you could read the charts, again, this goes back to, having your intuition and having your instincts and having the ability to read the charts. If you could read the charts, you don't need to know that that is called a double bottom. You just need to know that when you see this chart pattern, what price is attempting to do and what price is trying to do, right? So when you're talking about, to go back to your question, the cup and handle, the cup and handle is simply just a chart pattern. It's not one that we see very often. I don't know if I can find one here. It's not really, I might just draw it on the screen for you. Because again, it's not something that is used really, or that we see really often. It might be just a bit easier for me to draw it. Let me just draw it on the screen, right? So what might be, so essentially a cup and handle pattern is, it looks something like this. It's a cup and then a handle, right? So, but that obviously would be made up by various different bars. So it would be something like, excuse the terrible drawing, but it would be something that would look something along the lines of maybe a bar. This is terrible. I know the lines ain't straight. So very poorly drawn. Imagine all of these were bars or candlesticks, and it would essentially form this shape. So, excuse me. Let me get some water. Sorry. So essentially, what you're looking at, it's a similar thing. All you're looking at is, you had a resistance level here, all you're looking at is what does it mean when price is attempting to go up here, price then falls back in a pattern that is like this. What does that pattern then mean? Before it then again goes back to this level, it then pulls back again off this level in a certain shape or a certain pattern, and then tries to retry the level again, right? So again, it's just a name for a certain chart pattern. And excuse me, there are many different chart patterns and many different names for the chart patterns. Again, learning the specific names of, each chart pattern is not particularly necessary as long as you understand or can identify what the shape of price means or what it's doing, right? So again, these are all these various different shapes of pattern, and we're just identifying different shapes that exist on the charts, right? So not to worry if you don't particularly aren't able to identify them, right? It's just about being able to read again the markets and understand what they mean, right? Um so so let me go to this question. So Mo asks, how's the one-on-one communications work on the master tier? So the one-on-one communications is basically if you go to the master investor tier, I basically have a consultation with you. We will contact over like a Skype or something like that. And essentially what we do is we go through your individual circumstances. So rather than me teaching with a broad stroke, it's like, we can get on a call and like whatever issues you're struggling with, whatever particular things you don't understand on an individual late basis, whatever you're trying to set up. Say, for instance, you're having an issue trying to set something up, or if you have a specific, question that deals with your individual circumstances, we basically set up a one-on-one consultation. And then, you can have as much time as you want. You can sit on there if you want to just, have a talk about different things or different aspects of the trading or things that you don't understand, or questions that you just have generally around any sort of trading or investing. That's how the one-on-one communications really work with the master investor tier. We get a chance to get personally directly into whatever your personal circumstances and what you're trying to achieve and what you're trying to set up, and go through and work with on that level. I see all of Caligula's asked to go through AMC. I might leave that for this week, Caligula, only because I'm doing what my plan is to do for my next week is to break down what a short squeeze is. So I'm giving you guys a sneak preview. Next week's session is going to be about short squeezes, right? And identifying what a short squeeze is and also what a short squeeze isn't, right? So what I will do on next week, I will go through the AMC chart and just break down the whole what is a short squeeze, because we've got I don't want to go open that kind of worm just yet. So I promise you next week that I will do that. Let's go for Shiba Inu. You wanted to go through? Okay, let me pull up Shiba Inu. Shiba Inu. Where am I? What is the symbol for Shiba Inu again? Is it Inu, INU? Is that correct? What is what is the symbol for, the ticker symbol for Shiba Inu? Shiba, is it the SHIB in it? SHIB. Hey, Mo. Yeah, we're gonna discuss it next week, Mo. We're gonna discuss it next week. SHIB, I think it's SHIB, right? Yeah, that's what I said. Yeah, ship is Shiba Inu, right? So again, we're looking at trading view. We're looking at Shiba. Let's do our full analysis. Let me go off this. So the first thing we want to do is, again, this is our template. This is our focus on investing template. All of our key screens that we look at in order to evaluate an asset. The first thing that we want to do is look at is, let's do it this way. Let's do it this way. We look at the overall shape of the asset, right? And we want to see, how its past activity or past behavior has been, right? Again, going back to our example of, when we see people, we want to pull up their history. Like, let's say, for instance, this is Shiba Inu's Instagram, right? So you're scrolling back through Shiba Inu's timeline, and you're seeing its previous pictures, and you're seeing the kind of previous behavior or activity that it's got up to, right? So when we're looking at Shiba Inu and we're going back, looking at the history of the asset, we look at what kind of history or how it's performed previously in the past. Now, here's the thing. Anytime an asset is, whether it's a coin, it gets its ICO or initial coin offering into the market, or if it's a company, it gets its IPO, initial public offering into the market, you always find that there's volatility in the market, right? Because as I explained last week, what often happens is whenever a company or a coin is issued into the market, typically the people that have helped to create that coin or create that company are issued some form of stock or equity, or shares, or some sort of, some sort of compensation in order to create the asset, right? So, you know, those that have those things are often working for free or for reduced money, and as compensation they get these, coins issued to them, or they get a certain amount of shares issued to them, or certain amount of stock or things like that, right? So what tends to happen is the moment it gets listed on a market, people tend to want to cash in their coins or cash in their stocks or shares in order to recoup some of the, money that they've, or the time that they've put in working for the company or creating the asset, right? So what typically tends to happen is you want to you want to what typically tends to happen is when any time something is issued initially into the market, you get a lot of volatility and it usually goes down. The first thing you usually see is a strong bearish candle, right? You typically see a big, strong red bearish candle because, you know, people have cashed in all of their coins, cashed in all of their stocks or whatnot. So the first time you ever get, assets issued into the market, it's generally not a true reflection of the nature of the stock or the asset, right? Because, it's just getting through its initial, investment volatility. So you can see that here. It initially came in and it tanked, and then it came in May. By October you're seeing a strong bullish candlestick, and then we actually reached our all-time high. So it's not very clear from the initial offering what the trend would have been in the next few months. Now the next few months came, we got a massive spike, and again we then got another massive tank to the bottom. So you can see is wild volatility in this asset, up, down, up, down, up, down. And this is tend to what happens. This tends to happen again when you get new assets to the market. So typically when you invest in assets, we like to have assets that have a certain amount of time in the market, simply because it gives it a time to not only settle down from that initial volatility. Remember, when something is new, people, going back to the fundamental analysis, people find out about it at different times, right? So when people find out about it at different times, you get different waves and different impulses for various different reasons, right? It might be that the stock has already been entered. It might be that all of the people that worked on it tanked it, so brought it all the way back down. Maybe a site like Wall Street Bets gets hold of it. All the people on Wall Street Bets invest in it, so they pump it up. Then all of the people on Wall Street Bets exit their position and bring it down. By the time it's brought down, people have only just started hearing about what the Wall Street Bets are doing or something along those lines. Again, getting information late after it's already spiked. And then those, the second wave of people that are hearing about it late, hearing about, oh, Shiba Inu's going to pump, which is they're really hearing about this. This is what they've really heard about. They've heard about this. The move has already gone, taken place. People have already exited their positions and brought the market, the stock back down. But what tends to happen is those that hear about that information late jump in the market now. So they've already missed the wave. They're, again, trying to trade on past price action, which you can't make money on. And then you will get a second resurgence or a second pump of this market. And generally, it's never as high as the first one. Why is it never as high as the first one? The reason it's never as high as the first one is because there are people that heard about this pump late and they caught it on the way down, right? So people that caught it on the way down don't want to get out of their position because they're seeing the price go down and they're just waiting for an excuse for it to go back up for them to exit. So what happens is when that second wave of people come in and pump it up even just a little bit, it's an opportunity for all of those people to get out, right? So once those people get out, right, it's like it's an opportunity. It's like once the new flood of people get in, it's an opportunity for all of those people that were dying to get out can get out. So this is why you will see it will go in like waves like this. You will see a big spike, then not such a big spike, and then a smaller spike. So this is the trade-off of the bears and the bulls fighting each other, right? You will have those people that are already in the those people that are already in the asset or in the stock that are trying to get out, and then those that are just hearing about the news getting in. So what you're having is the bull market for fighting the bear market. So you're having bulls against bears, bears fighting bulls. The bulls are taking it up, the bears are taking it down. When the bears take it down, the bulls come back in and push it up, and then it comes back down again. So you're seeing like a bull versus bear fight, right? You're seeing one side trying to push it up on one side trying to push it down. So you will see that it eventually starts to cancel each other out because you have equal amounts of people trying to get in and trying to get out of the stock at the same time, right? So what we're looking at is we're looking at, in this instance, we're looking at a stock that came in, tanked for a while, got a pump or a spike, and then since then has never been able to reach those highs and ends up going down. And this is what you end up finding out with a lot of these, what I call like hype stocks or hype investments, or any stock that has big name recognition. So Shiba Inu has big name recognition. So if you have something that has big name recognition, you're going to be getting trading a lot on hype, right? And then what tends to happen is, you get waves of people hearing about it in different ways, and it tends to move away from fundamentals in the stock, right? Because there's a lot of emotion into it, because it's not really a technical analysis play. It's more of a name brand recognition play. Again, going back to what we spoke about, the examples with things like Nike and things like that, it's like people are having emotional attachments to it. So you have people that say, oh, Shiba Inu army and all of those things, and people that are investing into it because of those reasons are investing in because of emotional reasons and not necessarily because of the technicals. And what ends up happening is this will affect the wave of the or the nature or the flow of the stock or the asset, because it's not no longer trading on any sort of fundamental basis, and it's trading literally on waves of emotion. If Elon Musk comes out tomorrow and mentions Shiba Inu, everybody's going to run to Shiba Inu. If you're a fan of Elon Musk, or if you've been a fan of the Shiba Inu name or things like that, you're basically trading off of emotion. So it stops becoming about the actual value and the nature of the stock or the asset. Excuse me, in this case it's a coin, right? And it starts becoming more about like a public opinion, marketing, and things like that. But if we to do an analysis on it, we can basically see that on our trend filter has basically been green. Again, this is another indicator that we have on our focus on investing platform. And a green trend filter means that the stock is essentially, it's a bullish buy, and if it's red, it's bearish. And you can see it here, on these last two bars or these last two candlesticks, we can actually see that it's actually green on the red on the trend filter, excuse me, and you can see that the asset is going down, right? We're not trading anywhere near its all-time highs. And these are key. These dashed lines are for this asset, key pivot support and resistance levels. So we can see that we have two resistance levels above us and one support level below us. It's possible that this support level may hold this asset. So we might be trading at or around a support level here at this price. So we might see price go down a little bit to this line, but we're basically trading at our support levels. Now there is a lower support level here. Down at our, what number is this? This number is many zeros and 540, right? So there is a support level lower, but what it appears is that this support level here has been quite strong. The support level here has been here since January. And for this asset, this is quite a strong one. We can see that it's trading at around the support level. This support level has kind of held it for quite a while. So since this is a January support level, and prices never managed to go below the support level, so we can see it holding at the support level for quite a little bit of time. If we go to our daily time frame, we can look at a closer view. Again, we can see more of a better view of price bouncing off of the support level. We can see that it's actually trading below all of our moving averages. It's trading below the 200 simple moving average, it's trading below the 50 simple moving average, and it's trading below the 20 simple moving average, with there's gaps between all three of the moving averages, and also price is below the moving averages. Again, we're trading above this ground, this strong support level, but we're also trading below these resistance levels as well. So this is, if you're talking about price rising, it's got quite a few barriers to rise, right? It's got not only are we having a bearish price structure with our moving averages, that's indicating like a bearish market with this coin, but we've got for price to start becoming bullish again, it's got to turn itself around. It's got to break through the 20 simple moving average, the 50 simple moving average. It's got to break through this resistance level here at the many zeros 2998 level. It's got to then break through the 200 simple moving average, which was generally quite a strong area of resistance. And then we've got this strong area of resistance above it here at this, you want to say this many zeros and the 3507 area, right? So quite a few is so long story short, the asset is looking very bearish at the moment, and we're looking at quite a few resistance levels above it, restricting price to go higher, right? So unless you're going to see some kind of major injection in energy or something along those lines, it's going to struggle for price to go higher. So at the moment, I would say that this is a very much of a bearish asset. If you were to look at to trading it technically, because we're looking at a bearish asset, the play would be to invest bearishly in it or invest in it to sell. And maybe if we're looking at breaking this support level, if we get to a point where, you know, energy or sentiment in the market takes price to break through this support level here that we have here indicated by our red line, then the option to look for it, or the opportunity to look at it, would be to ride it back down to its previous low level of what we have here, which is this 481 level. So, you know, again, this is a asset that's been traded off of hype, or being traded off of, you know, marketing and not really fundamentals, right? It's been traded really off of emotion. But if you were to trade it from a technical point of view, you know, the opportunity that I would look for would be, if it breaks this support level, then maybe looking to ride it back down to its previous low support level down here, and maybe look to short this this coin in order to go to the levels of its previous low support level. All right, so, you know, we've actually, you know, overrun our time. So I see we've got questions here. We didn't get a chance to get through your questions today. I'm just looking at reading the questions. I see your question about BTC and ETH. So again, if you ask me these questions next week, I can kind of go through these in a bit more detail. You know, we've come to the end of our 2 hours. Yeah, again, we're here every week again. So next week, Sunday, you know, London time or GMT time is 8 p.m. Eastern time is 3 p.m. and Pacific time is 12 p.m. You know, if you have any questions, any comments, any charts or things you want me to look into, you can always come with your questions for those sessions, and we can, you know, go through and break down and give you guys analysis. If you guys want to learn how to analyze stocks yourself, and get into, you know, training your eye to see good investments, then go to focusoninvesting.io. Again, if you'd like to, you know, if you found this useful and informative, you know, invest in this show, you know, invest in your education. You can hit the Cash App, which is the British pound sign, and then do Focus on Investing. That's how you support the show. If you haven't done so already, please hit the like button. If you haven't done so, hit the subscribe button. You know, do the sharing. You know, help us to the platform to grow. And yeah, I thank you guys again for joining me. I hope you found this week's session very informative, and I'll see you guys next week. Take care. Peace.